Hey, good morning, options traders, and big welcome to the new traders we've had recently in the past week. Had quite a few register. It's great having you here. And a question that I get a lot from traders is about vertical spreads regarding the strikes that you should be using for your spreads. Because when new traders figure out about vertical spreads, they understand how powerful they are. But unfortunately, they usually just look at direction. Do I want a bull spread? Do I want a bear spread? And outside of that, they don't put a lot of thought into it. All right, maybe they say, well, let me buy the out-of-the-money options because I'm super bullish, or let me buy them in the money because I'm not real sure about how quickly it's going to move. And that's a better step in the right direction, but there are still so many more things that you have to consider for your vertical spreads. So to understand why, in this video, I'm just going to point out one of them, but I'm just trying to show you how you have to be careful about looking at things other than just direction for your vertical spreads. So as a quick refresher, recall what your vertical spread is. You are going to buy one option, whether it's a call or a put, and you will sell another option of the same type, meaning that both have to be calls or both have to be puts, not one of each. They must have the same expiration. So for instance, if you buy the May 100 call and sell the May 105 call, that would be a vertical spread. And in this case, it's a bull spread, it's a debit spread, and let's just say that you spend $3 for this spread. Well, this is the resulting risk graph. We get a bend right there at our long $100 call. We get another bend up here at the top for the short 105. And because we are separated by 5 points in these strikes, the most this spread could ever be worth is 5, that difference in strikes. And because we paid 3 for it, therefore the maximum gain would be that difference of 2. So a vertical spread is a limited risk, limited reward strategy. And one of the things that's nice about vertical spreads compared to other spreads is that you get consistent deltas. And what I mean by that is that some spreads will actually reverse their deltas depending on many factors, but especially for time and volatility. But bull spreads are either zero or positive deltas. They will never have negative deltas. So by a bull spread, we could either buy the call spread or sell the put spread. They will never have negative deltas. And again, that's not true for all spreads, but the vertical spreads are never going to change direction on you. Opposite will be true for bear spreads. Bear spreads are either zero or negative deltas, but they will never be positive. But unfortunately, if traders even learn this little fact, they think, well, it's just a matter of are you bullish or bearish? And if I'm bullish, I might as well just buy the cheapest vertical that I can because I just need the stock to go up. And again, that is really a limited and incorrect and dangerous way to approach your options trading. So one thing that I want to show you is let's consider, should you buy or sell the at the money for your verticals? Now, even if you're using both options in the money or both options out of the money, one of them is still relatively closer to at the money. And so these same principles that I'm about to talk about will still apply. So why is this so important? Why do we have to be careful about which option we're buying or selling? Well, to see why, let's take a look at some theoretical prices from a pricing model. And it doesn't really matter which numbers we use or interest rates, you're going to get the same effect. But for these numbers, I used a stock price of 100. So the $100 call will be the at the money, and 2% interest rates. But again, that really doesn't matter. Once you've set those numbers and you've got some theoretical prices, what I'm about to show you will always hold true. So let's say that we've got the 95 call, the 100 call, and the 105, and we're considering different bull spreads. Now we've got the market, let's say, is pricing the spreads at 20%. That's what I've got up here. The current prices are at 20%, which would be the implied volatility. So the 95 call is worth 569, has a delta of 83. The 100 call is worth 237, delta of 52, and the 105 call is 67 cents with a delta of 21. Now down below, if we buy the 95-100 spread, it would cost us 332, and it would have a delta of 31. But if we buy the 100-105 vertical spread, it would only cost $1.70, but it still has a delta of 31. And this also catches new traders off guard. Yes, if one is the long 100 call and the other is the short 100 call, they will have the same deltas. And that's because these two strikes, the 95 and the 105, are equally distant away from the at-the-money strike. So it doesn't really matter in terms of delta or in terms of our bullishness, but we do see that we have different prices. And this is where a lot of times traders will go, well, if I'm bullish, bullish is bullish, why would I pay $3.32 when I can pay $1.70? And that's just a really bad, incorrect, and dangerous way to trade options. There are a lot of moving pieces, so much more than just direction. So to see why, let's say that we buy the 95-100 vertical spread priced at 20%. But from our view, we think that volatility will be rising. So we think it's going to be moving from 20% to 30%. Well, if we're correct, take a look at what happens to our vertical spread. We're going to buy it for $3.32, and look what's happening to its price. It's actually dropping. We've given ourselves a very big negative edge, even though we might be absolutely correct that the stock is rising. And that's because we have sold the at-the-money option. And the at-the-money option is the most sensitive to volatility. So if we're short that option and the volatility is rising, yes, on a net basis, that is going to impact us negatively. And that's what we're seeing here. But on the other hand, what if we bought the 100-105, where we're long the at-the-money option? So if we're correct that volatility in fact rises, we're going to see that vertical spread move from $1.70 to $1.90. It's actually increasing in value. We have a 20-cent edge working in our favor, even though in both cases we have vertical spreads on the same stock and the same time to expiration. They're both bull spreads. But there's a hidden piece that people overlook, and this is a huge one. We have to take into account volatility. And that means we have to pay attention to which strike we're buying and which one we're selling. Well, now let's flip it. Let's say that when we're looking at our vertical spreads, that the prices are at 30%. This is the implied volatility. So these are now the prices on top. The 95 call is worth 653, delta is 74, 100 call is worth 350, delta 52. The 105 call is trading for $1.60 with a delta of 30. So if these are the prices and we are looking at the 95-100, it's going to cost us 303. That is buying the 95 call and selling the 100. We would have a delta of 22. But we might also choose to buy the at the money and sell the out of the money. If we buy the 100 and sell the 105, that's going to cost us $1.90, and it will also have a delta of 22. So you can see even under the higher volatilities, we still get the same deltas. Now they have been reduced, but they will be the same, and that's because in one case we are selling the at the money, and in the other case we are buying it. And other than that, they are equally distant away from the at-the-money strikes. So again, which one should we consider? Well, it's going to depend on our outlook for volatility. What if now we think that volatility is too high and it's going to be falling from 30 towards 20? And that these should be the appropriate prices? Well, if we buy the 95-100 and we're right that volatility falls, look what happens to the vertical spread. It actually increases in value. And that's because we have sold the at-the-money that is gaining value for us as volatility drops. Becomes a benefit. We've given ourselves a positive edge because we've accounted for volatility. Now, what if on the other hand we bought the 100-105? We bought it for $1.90, but we think that volatility is falling. Look what happens to its price. As volatility falls, it's moving from $1.90 to $1.70. It's becoming less valuable, even though we might be right that the stock is in fact rising. And these are just simply not ways to make money in the options market. You must consider the role of volatility. So probably the main point from this video is to understand that whenever you're looking at your vertical spreads, you have to consider the at-the-money strike. Should you be buying it or should you be selling it? And that means you need to understand the hidden role of volatility. So the main point from this video is to make sure that you consider the at-the-money strike. Where is the stock price? Which is the at-the-money strike? And understand that the at-the-money strike is always more sensitive to volatility changes. So if you feel that volatility will be rising, you should consider buying the at-the-money or the option that is at least closer to at-the-money. But if you feel that volatility will be falling, you should lean towards selling the at the money or selling the one that's closer to at the money. So again, the main thing to get from all of this is that all strategies, not just your vertical spreads, require an analysis of direction, time, and volatility. Because if you are trading options just strictly based on direction, you're going to find out the hard way that in many cases you're going to be right about the direction, but still lose money. And so hopefully this will at least open your eyes to finding out why. Options are multidimensional, stock is not. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. You can find it all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.